I'm Cynthia Rowland, and this is episode 65 of EO Radio Show. In today's episode, I'm going to wrap up the discussion of the new proposed regulations issued recently by the IRS and the Treasury Department. The Internal Revenue Service and the Treasury Department issued a notice of proposed rulemaking on Monday, November 13, which were officially published in the Federal Register on Tuesday, November 14, 2023. That started the 60-day comment period on the proposed regs, and sometime, possibly many years from now, these regs will be finalized. So this is big news for the charitable sector. To recap, these proposed regs provide guidance regarding donor-advised funds and the taxable distributions from them. There are 5 subparts to these new proposed regs. In episode 62, I started with an introduction to the basic rules that apply to sponsoring organizations and donor-advised funds. Episode 63 focused on the important definitions in the new regs 53.4966-1 and -3 and the definitions of the types of funds that are regulated as donor-advised funds. Episode 64 looked at the exceptions to the definition of a DAF, and in today's episode, the final episode on the new DAF regs, we're going to look at the regulations 4966-2 and -5, which cover the onerous penalty taxes and the definition of taxable distributions from donor-advised funds. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. In today's episode, we're going to talk about the new proposed regulations under 53.4966-2 and -5, and I'll have links in the show notes to the actual proposed regulations for listeners who want to read them. These 2 regs address the part of the matter, that is, the determination of a taxable distribution and the amount of the penalty taxes imposed. So to start into this discussion, let's assume we have a fund that we realize is technically defined as a donor-advised fund. It doesn't meet any of the exceptions. And so now we need to be very aware of what distributions we make from that fund, whether it's a taxable distribution. And if it is, how do we determine what the penalty tax is that applies? That's our focus today. So to recap, a donor-advised fund is defined generally as a fund or account, number 1, that is separately identified by reference to contributions of a donor or donors. 2, the second prong of the test, the fund is owned or controlled by a sponsoring organization. And part 3, or prong 3, with respect to which a donor or any person appointed or designated by the donor, that's usually referred to as a donor advisor, has or reasonably expects to have advisory privileges with respect to the distribution or investment of amounts held in the fund by reason of the donor's status as a donor. So that list of the 3 prongs, that's loaded with technical terms, and the meaning of all those terms is covered in our previous episodes. But like I said, we're going to assume today that our fund that we're focusing on is in fact a DAF. So what is a taxable distribution from a donor-advised fund? Section 4966 defines a taxable distribution as any distribution from a DAF to any natural person or to any other person, meaning an organization, unless that distribution to another organization meets the strict criteria for expenditure responsibility. So the proposed regulations incorporate the statutory definition of taxable distribution. The proposed regs set forth an anti-abuse rule providing that if a series of distributions through intermediary grantees is undertaken under a plan that results in the inconsistent use of the funds, inconsistent with the purposes of 4966, the distributions are treated as a single distribution for purposes of these taxable expenditure rules. So in other words, if you can't do it directly, you can't do it indirectly. For example, the Treasury analysis of the proposed regs notes that if a donor advises a distribution that the sponsoring organization subsequently makes from the DAF to Charity X, and the donor or the sponsoring organization arranges for Charity X to use the funds to make distributions to an individual recommended by the donor, that distribution is treated as a taxable distribution from the sponsoring organization directly to the individual without regard for the role of the intermediary in that chain of events. The proposed regulations construe the term distribution very broadly. The proposed regs provide that distribution generally means any grant, payment, disbursement, or transfer, whether in cash or in kind, from a donor-advised fund. The proposed regs also provide that any use of DAF assets that results in a more than incidental benefit to the donor or related persons or the donor advisors is also a deemed distribution and generally is a taxable distribution. An important footnote here is that a distribution that results in a more than incidental benefit to a donor or an insider can also result in a tax under 4967. So if we have a distribution that falls into this category, you have to look at multiple code sections to see what the total of the taxes are that would apply. The proposed regs also provide that investments and reasonable investment and grant-related fees are not treated as distributions under these rules. Investments generally aren't treated as distributions because they typically merely reflect the change from one form of asset to another. The proposed regs consider investments for this purpose as including both debt and equity instruments, with an exception, though. An investment that is a zero-interest loan is not treated as an investment since there's no real purpose or provision for obtaining income or funds from a zero-interest loan. So that doesn't really meet the criteria of of an investment unless the organization, the lender in the case of a zero interest loan, if they follow expenditure responsibility rules, there might be some circumstances where the IRS and the Treasury Department would respect a zero interest loan as an investment and not a taxable distribution. Reasonable investment and grant-related fees from a donor-advised fund are generally accepted as not impermissible distributions, unless it's an unreasonable grant-related or investment fee. Whether a fee or an expense is reasonable depends on all the facts and circumstances. We've heard that many times before in these proposed regs. As an example, the Treasury discussion of the proposed regs notes that an expense charged uniformly across all DAFs is generally considered reasonable and not a distribution, and a particular expense charged to a particular DAF that is actually related to the expense of a particular expenditure. For example, often expenditure responsibility grants are quite expensive to supervise or to do the diligence on, and those can be considered to be reasonable depending on the facts and circumstances. Then the regs, of course, note as an anti-abuse reminder that any expense charged solely to a particular DAF that's paid directly or indirectly to a donor, donor advisor, or related person is still going to be a deemed distribution subject to the taxes under 4966 and possibly also 4958 and 4967. So moving on from the distributions that are investments, there's also a discussion in the proposed regs, or there are provisions in the proposed regs that apply to distributions to charitable organizations. So the statute itself, 4966, provides that a distribution to any charitable organization other than certain disqualified supporting organizations is not a taxable distribution. And so this is similar to existing guidance under the private foundation rules. The proposed regs consistently provide several categories of organizations that are described as charitable organizations and that are respected as such for purposes of these rules. So these proposed regs first provide that an organization is considered to be a charitable distributee if it's described in both sections 170B1A and 170C2 of the Internal Revenue Code without requiring that it be a U.S. organization. For example, a taxable organization that operates a for-profit school is not treated as a charitable organization for these purposes because it's not described under 170C2. Second, an organization that's a governmental unit is considered an organization that's described as a charitable organization to which distributions may be made from the donor-advised fund. Third, a foreign government or an international organization is also treated as a charitable organization that is a qualified distributee under these new proposed regs. And in that regard, the proposed regs also adopt the rule that DAFs may make grants to foreign organizations based on the same equivalency determinations that private foundations use for purposes of determining whether a foreign organization is the equivalent of a domestic public charity. So that's a very useful piece of guidance. A sponsoring organization may also make a good faith determination that a foreign organization is equivalent to a public charity using the same procedures as the procedures that are permitted for private foundation grantors. These procedures generally provide that a determination by the grantor or sponsoring organization from a DAF is ordinarily respected as a good faith determination if it's based on current written advice from a qualified practitioner, typically a lawyer, and the organization reasonably relies in good faith on the written advice. So a word about disqualified supporting organizations. The taxable distribution rules define any Type 3 non-functionally integrated supporting organization as a disqualified supporting organization with respect to any distribution. For a recap or a summary of the supporting org rules, and in particular the Type 3 non-functionally integrated supporting orgs and some recent regulations that came out on that, you might want to go back and listen to episodes 23 and 24 of EO Radio Show, which talk about supporting orgs generally, and episode 61, which covers the recently finalized proposed regulations under the supporting org rules. So by way of quick summary, the 4966 rules in the statute disqualify any type of supporting organization if the donor or any donor advisor and their related parties directly or indirectly controls a supported organization. So this is really an anti-abuse rule. Under the taxable distribution rules in the statute, a distribution to any entity that's not a charitable entity or to a disqualified supporting org is a taxable distribution unless two things pertain. One is that the distribution is actually for a charitable purpose and the sponsoring organization exercises expenditure responsibility. So if you have a potential grantee from a DAF, it's not a charity under these proposed regs, but the organization exercises expenditure responsibility, then it won't be a taxable distribution. So focusing in on what is a non-charitable purpose under these regs. So that's non-charitable purposes, taboo. What is a non-charitable purpose? The proposed regs provide that for purposes of these rules, distributions are treated as charitable whether or not carried out by an actual charity. However, a distribution to be used for an activity prohibited under 501c3, that is an impermissible or illegal activity, or an activity that would cause the loss of tax exemption if it were a substantial part of the charity's total activities, is not for a purpose that's specified in 170C2B. That is the definition of a charitable purpose. So, for example, a distribution used for political campaign activities or attempts to influence legislation is considered to be for a non-charitable purpose. The proposed regs also include a requirement similar to the private foundation regulations that a grant to an organization other than a public charity is not considered to be for a charitable purpose as specified in the Internal Revenue Code. So to recap, expenditure responsibility. The statute 4966 requires sponsoring organizations to exercise expenditure responsibility consistent with the rules that apply to private foundations. So the proposed regulations under 4966 directly cross-reference the 4945H expenditure responsibility regulations applicable to private foundations with one modification. The proposed regs provide that the distributee, that is the grantee, is required to agree not to make any grant from the grantee that does not comply with expenditure responsibility requirements. This grantee from the DAF has to also agree that it will not make a grant to any natural persons or make grants, loans, compensation, or similar payments to a donor, donor advisor, or related person with respect to the DAF. So for the purposes of these rules that pertain to the secondary use of the distributions or re-granting or redistributing an expenditure responsibility grant from a DAF, the definition of grant in the private foundation rules applies rather than the broader definition of distribution in the 4966 regs. So if the definition of distribution applied, the distributees would be required to exercise expenditure responsibility in the purchase of goods and services, which isn't the intended outcome under the proposed rules. So that's why the definition here is a little bit narrower than the general rules for the expenditure responsibility test. So to wrap up, let's talk a little bit about the actual calculation of taxes on taxable distributions. In discussing the actual calculation of the taxes, we're looking at the new proposed reg under 4966-2. 53.4966-2 addresses the determination of the tax amount on a taxable distribution. Consistent with the statute, the proposed regs under 4966-2 provide that the excise tax is 20% of the amount of the taxable distribution, and that tax is imposed on each taxable distribution from a donor-advised fund. The excise tax is paid by the sponsoring organization of the DAF. So in other words, it's not necessarily taken from the DAF account, but it is taken from the general assets of the sponsoring organization. The provisions of the proposed Reg 53.4966-2 are generally similar to the rules of 4958-1 regs under other excise tax regulations that relate to the calculation of tax on an organization and its managers. In addition, the proposed regs under 4966 provide that each fund manager who knowingly agrees to the making of a taxable distribution is liable for an excise tax equal to 5% of the amount of the taxable distribution, up to a maximum of $10,000 for any one taxable distribution. If more than one fund manager is liable for the excise tax, all such persons are jointly and severally liable for the tax. The proposed regulations define a fund manager consistent with the statute. These proposed regulations also provide that the agreement of any fund manager to the making of a taxable distribution, the agreement itself, means any manifestation of approval of the distribution that's sufficient to constitute an exercise of the fund manager's authority to approve or his or her authority to exercise discretion in recommending the approval of a distribution by the sponsoring organization, whether or not that action is the final or decisive act on behalf of the sponsoring organization. It's a broader definition than one would ordinarily expect. A fund manager is generally considered to have agreed to the making of a distribution with knowledge that it's a taxable distribution only if the manager, 1, is in fact aware that it is a taxable distribution, or 2, alternatively, has knowledge of facts sufficient to determine that based on those facts, the distribution would be a taxable distribution, and that fund manager negligently fails to make reasonable attempts to ascertain whether the distribution is in fact a taxable distribution. A fund manager generally is not considered to have been negligent in failing to make reasonable attempts to ascertain whether it's a taxable distribution if the distribution is made to a charitable organization listed in Publication 78. So that just goes to the point that before approving a distribution, the fund manager needs to be sure that someone has checked the IRS database to ensure that the grantee organization, in fact, is listed by the IRS as a charitable organization. Wrapping up our series here, I think it's important to note that these regulations are proposed to apply to taxable years ending after the date of the final publication of these regulations. Note that right now they're proposed regulations and they're not binding. A taxpayer may, however, rely on these proposed regs for taxable years ending before they are published in the final regs. So if there's something in these final regs that's useful to the sponsoring organization, they can be relied upon as of right now. As for the disaster relief fund rules in these proposed regulations, the Treasury guidance does note that these rules are consistent with the guidance provided in previously issued notice in 2006. However, in some instances, these proposed regs modify that guidance. And so for taxable years ending before the date of the final adoption of these regulations, taxpayers can rely on the guidance either in the earlier 2006 notice or alternatively these proposed regs if they wish to do so. So that's all for this episode and for our little series on the proposed regs under the 4966 rules for taxable distributions by sponsoring organizations from donor-advised funds. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource brought to you by the Exempt Organizations Group at Farella, Braun & Martel. Farella also now has several YouTube playlists that organize the podcast episodes by interest area, so be sure to look there for episodes applicable to your interest areas in the legal world of nonprofits. As always, if you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.